Good morning. My name is Xavier. I'm one of the 4 partners of Emerald Management. At Emerald Management, we are managing 2 funds. One is investing in bridge and mezzanine financing in real estate. And the other one is the fund of funds, the one I'm coming here to explain. Although I'm not coming to explain the investments of the fund of funds, but more the metrics and the tools we use to do the due diligence of the funds. Now, before I need to explain you a little bit why we need to use different tools and we need to use a different approach than a standard hedge fund or a standard equity fund or a bond fund. Let me start. What is the issue that today all the investors have? Well, one of the issues is that after 2008, what we saw is that the traditional and correlated investments, when there's big market movements, they're actually not correlated, uncorrelated. They are actually correlated. So you should lose and win money from some assets, and actually you lose money with all of them. And that happens when the market movements are pretty strict. The correlations stop working. That's one issue. The second one is yield. Today, bonds, for the next 5 or 10 years, probably you're going to have a negative carry. The expected yield from the bond markets, perhaps, is not even going to cover for inflation. So investors are searching for investments that first can give them some yield. Second, give them an uncorrelated access to investments. And that is something that they don't find, because the traditional asset classes, they already have them in their portfolio. Equities, bonds, commodities, real estate. So the issue that we are trying to solve at Emerald, at the Emerald Fund of Funds, is to find those new asset classes for you. And I'm saying new because asset classes are not new. The only issue is that they are not being made accessible to the traditional investors. Traditional investors who have $1-5 million to invest. People who have $50 million to invest, like pension funds or insurance companies, they have access to everything, and they already do. So what are we trying to do? First, we are trying to look for alternative assets. And our definition of alternative asset is an asset that the future return that it will have, even if markets go up 5 or 10%, their actual return is going to be unaffected. So as you perceive when you make investments in equities, if the Nasdaq goes up 10%, that's going to have an impact in the interest rates on your bond portfolio. And the same thing on commodities, because they are quite highly correlated. So we are looking for asset classes and funds that invest in those asset classes, that the return is not going to be affected by those minor movements of the markets. The other issue we want to do is a fund where we can manage that volatility we were talking before. We want assets where the volatility is also uncorrelated to the other traditional asset classes. So when you look at the applied volatility of the asset class we invest in, you want an asset class that, again, their behavior, the volatility also, and the risks, has nothing to do, has no key drivers that are similar to the ones we have in equities, in bonds, and in alternative assets. And last but not least, also, what we have realized, and that's not a priori but a posteriori, is that those alternative assets, mainly because people don't have the know-how, are asset classes that are not highly pursued by investors, because they don't have the capacity to do diligence, understand them. And also, there's no vehicles that allow investors to access them in a transparent and open-ended way. So that's what we are trying to do at Emerald Management, at the Fund of Funds. Try to look those asset classes, invest in them, and give you a fund of funds that will be well diversified. Now, what is the issue? The issue is that when you want to invest in an equity fund, when you do the due diligence, there's very standard things you do. And I'm going to start here now talking about the due diligence process. So imagine that you want to invest in an equity manager in the Nasdaq. You know, he's buying a very, very liquid asset class. An asset class that each second has a price that changes. It's market price because there's thousands of people interacting. Each share is the same one as all the other ones, so there's homogeneity. So to do due diligence on this manager, besides the traditional legal due diligence, service providers, risk management tools that he uses, what you need to understand is he is good providing alpha to you. if he's good at trying to predict or trying to structure a portfolio that on the midterm is going to bring you value. And that, in the asset classes we invest, in the alternative asset classes, you don't have it. Why? Because the majority of them, they are not homogeneous asset classes. So like, for example, a house. The price of this house, of this building, is going to be X. But if you had the same building, 10 meters on the other side, covered by a tree, where you have the shade, or nearby the road, the price will be somewhat different. Even if it's the same structure, built the same way. Every asset is different than all the other ones. So when you approach the due diligence and the analysis of the value add of the manager, you need to understand those differences in the asset class you're trying to value. Because the manager needs to recognize them. But you need to recognize if the manager knows how to differentiate them. And that is not obvious. And that's one of the key cornerstones of what we do. Each asset class needs different quantitative metrics and qualitative metrics or tools to be able to understand what the risks are, what the expected return will be, and last but not least, if the asset manager brings value to the management of the asset. Sorry. So all those metrics, it's not a process where you're going to say, okay, I need to apply 1, 2, 3, 4. It doesn't work that way. In fact, the metrics that you will apply, you will start to learn them as you start doing due diligence, as you start to understanding the asset class. Because believe me, it's not going to be the same thing buying real estate here than buying real estate in Spain or in Switzerland, because the legalities are very different. The exit strategy and the time frame you have is going to be very different. The factors that are going to explain the pricing of the asset class are going to be very different. Now, buying and selling equities in the US, New York, and Japan, it doesn't have any differentiation because you have a leaking market with a price each second. And that's one of the key variables that makes all these due diligence so different. And for each asset class, also different than all the other ones. Because, for example, on an asset class that now we will be investing, bridge and mezzanine financing. Bridge and mezzanine financing is another asset class we think is great. Why? Because you are giving a loan to a company that has a building, for example. The building is worth 100, and he needs 80 or 70 as a loan. Now, in 6 months, or 3 months, or 12 months, he's going to repay me back. So I give a loan of 70. In 6 to 12 months, I'm going to pay back, but I'm over-collateralized by 30%. So my risks are, what is the probability that in a 12 months or 6 months scenario, the person doesn't pay me, and I need to sell and I don't recover 70, and therefore the price of the property has decreased 30%. So it's kind of small. Now we like the asset class because we are getting paid double-digit returns. So the yield of the loan is much higher than return on the properties on a mid to long-term basis. So we think it's fantastic because the traditional risks on real estate, we don't have them, but we have the full collateral. Now the question I'm going to bring to you is, how do you do the due diligence of funds that do bridge and mezzanine financing? There's no index. You only have interest rates in the market of lending, but there's not a transparent market on bridge and mezzanine. How do you know if a property is worth 70 or 100? Do you use one independent valuation expert? You use 2? How do you know the guy knows his market? How do you know the lender knows the place? Because if you give a loan to a building that is going to be here or in the southeast of Jerusalem, if you don't know the location, you don't know the risks, because you don't know what kind of exit strategy to sell you will have. So, as you see, it's not as simple as saying, okay, I'm giving a loan, or I'm buying a real estate property, the price is X and the loan is Y. It's not this, because the pricing is not transparent, and the value added cannot be crystallized on a short-term basis, because there's no market pricing. So the tools we need to employ not only try to understand the asset class per se, but the location and the manager. And that is different by each asset class. So as you see, the complexity of the due diligence on different asset classes, it needs to be onboarded on an asset by asset. And let me go to some of the tools that we use. First, as a portfolio, you don't want a portfolio that's only going to have one asset class, because although it may be very great, like all the assets, they go up and down, they have periods. So for example, bridge and mezzanine financing for the next 5-6 years is going to be a great asset class. But then we need to see what happens with the yields, what happens with the laws, what happens with the country in real estate. There's many things you need to look. But on a medium and short-term basis, it's an interesting asset class. But you need to see other asset classes to diversify your portfolio. Now, the second thing that we do when we analyze the market is we have found the asset class. We have tried to understand what are the key return drivers of that asset class. Now, the problem is that we are an open-ended fund. We cannot invest in a private equity fund that will have 7-year lockup. So we need to find an open-ended fund that invests in this asset class, and the manager adds value, but it's not simple. Because as I told you before, if you're a pension fund or insurance company, no problem. They're already doing that for the last 30 years, bridge and mezzanine financing. But if you want to invest 100 or 200,000 or 500,000 or 3 million, there's no problem. It's very difficult to find a properly managed and well-regulated, open-ended fund. And also another issue, it's not the same thing to do due diligence on a closed-end product than an open-ended product, because you have additional risks that you need to manage, like liquidity, like pricing. That is key. So I need different metrics, not only to understand the asset manager, but then to be able to find proper managers for this asset class. Now, the third thing is I need to do the due diligence on that specific manager. Again, I'm found with the new different issues, because some of those funds, because they don't have a market price, you have an important issue. Is the valuation model they use. Because imagine that you buy a real estate fund, and this real estate fund, there's no market price. And you see that the NAV of the fund keeps going up. And you say, well, this is a great fund. But if you do a little bit more due diligence, you may see that the manager updates the fund at 0.5 or 0.7 each month, because they make one assumption, that it will grow by X amount of basis points each month. And if the auditor signs for that, then it goes. Now the question is, if you try to sell, is that the actual value of the properties? Because if there's a difference between the accounting value and the market price that the property would get, I would personally never invest in that fund, because you carry a lot of liquidity risk. And not only that, if the price is different, people who come into the fund and buy shares, they may be buying cheap and therefore taking your money into their pockets. Same thing for redemptions. So it's important to understand that the issues between one manager and the other could be very significant. Not because of the value added, but because of the implicit risks that their methodologies bring into the fund. Fourth issue is, how are we sure that everything is done more or less properly? And I'm saying more or less because the only way is to be the actual manager. So from our case, first you need to have access to all the information. So the first thing we ask all the time when we start the due diligence is to see all the contracts and all the flow of the money. From the moment that the money gets out of our fund of funds, for example, who gets it in their open-ended fund? From their open-ended fund, how it arrives to own the asset. What are the intermediaries that take care of that? What is the relationships on those intermediaries and their obligations? Because, for example, a bank in Cayman, for example, a custodian will not have the same responsibilities as a custodian in Luxembourg. A custodian in Luxembourg, if the fund has invested and the assets don't exist, the custodian will pay you the money, because they are responsible that the assets exist. So every country has different issues. And those laws regulating the service providers are important also for you. So we need to, it's very important that we can follow the path of money, not only because you will understand all the potential risks, but because you will also sometimes understand better how the asset class behaves. Because when the money stops, that money stops in a place for a specific reason. And that means that there's a decision made in that point. And you want to understand that decision. Who made it, and under what variables. And again, as you can see, each asset class is different. Real estate, lending, ILS, each asset class is different. And for each asset class, you need to sit down, open your mouth, and understand how the asset class behaves and what are the risks. It has nothing to do with the due diligence of an equity fund or a long-short hedge fund dealing with liquid markets than with alternative assets. You start from the same basis. You need to do your legal risk, your due diligence, check the managers, check the value added. But when you get into the nitty-gritty of the value added of the asset class and the fund we're investing in, it's very different. Now, the other thing also is, you see a fund that the returns are very good. There could be many reasons why the returns are very good. The problem is that if you don't ask the questions, if you don't see the breakdown of why the NAV increases each month, you will have no idea. Let's assume real estate fund. A real estate fund, and you see that the real estate fund invests in houses that rent their apartments. And you see the yield is monthly 6%. Boom, boom, boom. From time to time, it goes to 8%. You say, oh, well, that's nice. Now, could it go down to 2% or 1%? You need to know that. And if you don't know why this happens, you will know why it could happen going down. Because if the valuation depends on the occupancy rate, or if the valuation depends on the market price of those buildings, you are sitting duck. You look at the returns, and you don't know what are the variables that are influencing the appreciation of that NAV. Is it the appreciation of the properties? Is the increase of the yield? Is because you have made improvements in the house and that house has increased in value? You don't know. And that's a key important variable, because you may have a return and you want to see what quality of returns you have. Until you cannot break down those key attributions on your return, you don't know why you make money. Let's assume that the attribution of real estate fund is going to be, let's assume, yield, the yield you get. And you look here at Israel today and you say, well, the property is booming, I'm going to be making money. Well, in this fund, no. Because the return doesn't depend on the value of the property, but on the yield it can generate. And the relationship between market prices and yield sometimes is contrary. So you need to understand what drives the NAV appreciation, each one of those variables. And then last thing, and that's the trick. One thing is to understand standard conditions, or a little bit stress test the conditions. Now the other problem is, what could, okay, I'll go fast. What could be a catastrophe? You need to stress those scenarios and see how the manager can hedge them or can get prepared to them. Because that at the end is going to be your safety of your capital. And that's the key thing. In many alternative funds, your capital normally is safe the way they are managed. But you want to see under scenarios like 2008, what could happen with your capital. Because the yield is normally there because of the nature, the alternative. So you need to understand what could happen under worst case scenario. And again, this is not, the stress testing scenarios are not going to be the same ones you can do with equities or bonds, because you have tons of data, you have distributions that are clear. In alternative assets, you don't have them. And in fact, each scenario is completely different from the other, so they cannot be extrapolated. Okay. Well, the other point is standard. You need to know what kind of risk management tools he has, if he has leverage or not, if he has a lot of cash or not. Those things don't change much than from the other standard hedge funds. Okay. Now the last thing is why a fund of funds. In hedge funds, well, yeah, there's a reason. If you know a little bit about a hedge funds, you yourself can do the due diligence and can select of 5,000 hedge funds, long, short, or volatility arbitrage, any. Now the issues you have seen with alternative assets is that to do the due diligence, each one is a different bird. And you need to develop that specific know-how for each one of those asset classes. In fact, in some of them, we have contracted specialists, managers of that same asset class, to help us on the due diligence understanding of the operations of those funds. So it's not a standard approach to due diligence. You need to create ad hoc the tools that you see that you need when you start understanding the asset class. Thank you.